People in finance, especially finance influencers, they're all lying to you. They're all saying, invest in the stock market, invest in the S&P 500, invest in America, because America is a growing economy. You want to be part of that story. But the reason why the S&P 500 is going up over time is not the American economy doing that great. Because why then does the gold price over the very long term go up as well? In the end, it's still the same brick of gold. What's actually going on here is, of course, a devaluation of the dollar. And that devaluation happens faster than officially most people want to realize. This here is how fast the US dollar is declining in value. This is the inverse of the US money supply. Here is that money supply. It's USM2 that grows by 6.8% per annum. So it doesn't matter what kind of asset we have. As long as it stays desirable, as long as it's limited in its supply, it should go up by 6.8% per annum. That's why stocks go up. That's why gold is going up. That's why houses go up. The house is still the exact same compared to 30 years ago, yet the price went up just because the US dollar is devaluing by 6.8% per annum. Now, this has some very strong implications. For example, this here. This is the S&P 500 divided by the money supply. So this would be US stock performance if the US dollar was not devaluing, if we actually had a constant monetary base. Now the case for investing in the stock market isn't necessarily that great anymore, right? This is a very long-term chart. It starts in 1959. And if the dollar was not devaluing, it can take 36 years to just get the purchasing power back. The drop from top to bottom is 74% over here. So that's 1961 to 1982. Or from the dot-com crash up until the end of the global financial crisis, a drop of 73%. The dotted line over here, that's the average ratio of the S&P 500 to the US money supply. The yellow circle over here, that's when Bitcoin got created at the height of the global financial crisis. So words matter here, right? It's not about investing in something, it's rather to get rid of our fiat currency. It doesn't matter where we put our fiat currency as long as the thing that we buy does not rot away. So if we buy a house, if we buy a bar of gold, if we buy stocks, if we buy a car that we maintain very well, it's also rare in supply and that continues to have demand in the future. That will also go up over time. We cannot store our wealth in bananas or in apples, but we can store them in things that are limited in supply, just to get rid of the fiat currency. The real thing that we want to do is we want to not own any fiat currency. We want to have our wealth in something else. And that something else can just be a basket of random something else's, right? So a bit of property, a bit of precious metals, a bit of stocks or crypto can also be the cheapest of the something else's. And maybe we want to consider, what do we actually want to buy with our fiat currency? If we get out of fiat, what is actually cheap right now? And it's not clear whether or not the S&P 500 is particularly cheap right now if the historical average is over here. If we were to come down to that average, the S&P 500 could fall by 50%. Now check this out. This is gold relative to the US money supply. Doesn't this look quite similar to the chart of the S&P 500? Gold is simply just holding its value. Gold is simply just keeping pace with the monetary debasement. It's still the same coin, it's still the same bar, it's the exact same thing, but it's going up over time, measured in US dollars, because the US dollar is rotting away. It's rotting away at 6.8% per annum. Now gold, unfortunately, is also above its long-term equilibrium price. So it's hard to make the case that gold is very cheap right now. Coming down to that equilibrium, it could drop by 43%. But what's the better option? Should we rather be in the S&P 500 or should we rather be in gold? So if we just had those two asset classes, where should we allocate more towards? We just want to get rid of our fiat currency. We want to dollar cost average into something. And let's say we only have gold and we only have stocks. What should we actually buy? The answer isn't that obvious when we just look at the US dollar chart of gold or at the US dollar chart of the S&P 500. But again, this is where this channel is giving you the edge. If you appreciate this, feel free to give it a like and feel free to also subscribe. This here is the S&P 500 divided by the gold price. How expensive are currently stocks relative to gold? And again, we've got our equilibrium as the dotted line. Sometimes stocks are expensive, sometimes gold is expensive. And it appears as if currently gold is still the better option compared to stocks. Gold has already outperformed since the end of 2021. Well, the S&P 500 has underperformed gold by 42%. Now, there are different ways to look at this chart. Maybe the S&P 500 does outperform gold very long term because we do have higher highs and maybe we do have higher lows as well if we ignore what happened in 1980. But what I think is the most important part here is that there are clear trends. Sometimes gold is doing better, sometimes the S&P 500 is doing better. We can simply just use moving averages to determine that trend. When the green squiggly line is above the moving average, we should be in stocks. When it's below, we should be in gold. Currently, we should rather be in gold. The question is, what is the best moving average here? For that, we use the backtesting platform of this channel, Bitcoin Strategy Analytics. We optimize the best moving average for the S&P 500 relative to gold. We use weekly data and we check what happens for the best result. At the x-axis, we've got the moving average duration in weeks. So this goes all the way up to the 4-year simple moving average. Following the trend in general tends to outperform, just holding a mixed bag of gold and the S&P 500. So rebalancing our portfolio does make sense. The best moving average period is over here. It's the 8-year week simple moving average. That's then how this outperforms, right? So gold and the S&P 500 have roughly the same kind of performance over all of those years. The S&P 500 roughly outperformed by 1% per year. But really, when we time the trends, we can get an additional alpha of almost 8% every single year. That's then how that looks like over time. Have a look at this strategy equity. Very nice continuous chart. So being more in stocks or being more in gold, depending on where currently the zeitgeist is, does make a lot of sense. And currently the zeitgeist is towards buying gold, not so much stocks. So that's how this currently looks like. You've got the 80-week simple moving average over here. We would have gone into gold at the end of 2024. And since then, the S&P 500 underperformed gold by 33%. And we should still be more in gold than in the S&P 500. Now, this is disregarding taxes. This is disregarding transaction fees beyond 0.05%. But it does give us a first indication that maybe we shouldn't just have a random basket of things, but we should buy the thing that's currently getting accumulated more and more. And it intuitively also makes sense. The world is becoming less and less safe. We get more segregation. We potentially also have the decline of the US. We get more and more conflict, and that conflict might ask for a hedge. That hedge that's independent of the financial market could be gold. When both asset classes, so stocks and gold, roughly perform the same as the US monetary expansion of 6.8%, really the decision comes down to what's currently cheaper and what's currently more trendy. And it looks like currently gold has the trend on its side. I've been in this investing game for the last 8 years roughly. I started this channel 5 years ago and I hit my first million 1 year ago. And I did this by timing the market. I'm timing Bitcoin, I'm timing the S&P 500, I'm timing gold, and I use data like presented in this video. You could just set and forget and buy a diversified basket of things and forget about all the complications. That's definitely a viable approach, and it definitely helps to protect against the inflation tax. Right, the debasement tax, the 6.8% per annum. But I think it's worth it to get informed. I think it's worth it to go beyond what everybody else is doing. That's what this backtest here is showing, right? An additional 8% every single year with a data set that starts in the 1930s over such a long time period. You can't just follow Dave Ramsey and Warren Buffett and buy the S&P 500 blindly. Or you can go one step further and make the effort to look at the data and see where currently the money is flowing. And it's currently flowing towards gold. Again, gold is historically not cheap. It's just cheaper compared to most stocks. This is simply just an analysis of US stocks versus the gold market. We are not looking at property, we are not looking at other precious metals, we are not looking at crypto. Things become a bit more complex once we look at all of the asset classes. If you found this video useful, feel free to give it a like, it helps the channel grow. Feel free to also subscribe. I publish videos like this regularly. If you want to dive a bit deeper and you want to see what I currently do with my money, feel free to also check out the premium membership. Link to premium pops up here on the screen and is also in the pinned comments. See you next time. Cheers.